Erin and Dev, we're here today to talk about the difference between saving and investing. Dev, these two terms are used very often interchangeably in the industry, but they're actually quite different terms. Can you unpack for us the difference between saving and investing?
Sure, of course. Before we get into that, something that we just have to understand first is how inflation works and why understanding what purchasing power is before we get into an investment or savings decision. So I'm going to use a 100 Rand note as an example. So today I could go out with this 100 Rand and buy myself a breakfast. Now, if I took this 100 Rand note, put it in my pocket and took it out 10 years later, I can assure you it's not going to buy me the same breakfast that it can buy me today. And that's just an example of how inflation works. So when we looking at investing or savings, it's important to understand that we're either trying to protect our purchasing power or we're trying to grow our purchasing power.
And to just jump in there, the reason why we like to differentiate between these two is just help clients compartmentalize the difference between short-term saving horizon and a long-term saving horizon, because how we would invest would be quite different, and inflation plays a role into that.
Yeah, so if we take someone who has a short-term investing goal, and this could be anything between one to 3 years, it's important to understand that protecting your purchasing power in the short term becomes more important than trying to grow your purchasing power. Because in order to grow it and target a return above inflation, you're going to have to take on a lot more market risk, and ultimately this brings in a lot more volatility into the investment or savings portfolio.
Dev, you mentioned volatility, which is something that goes hand in hand with investing. Can you explain to us what to consider when it comes to saving and investing?
We have a lot of events over the last couple of years that can help us understand volatility a bit more. So if we go back to 2020 when the outbreak of COVID happened, what we would have seen then is high examples of volatility in the market. COVID broke out across the globe, markets crashed in a very, very short period of time. Subsequently, they had a good bounce back. Over the next 18 months, markets experienced a bit of an upward tick until we had Russia invade Ukraine, and we had another correction in the market. Shortly after that correction, we then had the inflation crisis in the UK, US, banks collapsing, and we've had more pressure on the markets. So this is just an example of how volatile markets can be. If we take an example of someone wanting to put a deposit on a house in the short term. Now we know we've just started a family, we know in 2 to 3 years time we want to put down that deposit, put our roots down and purchase a property. Now while it might be tempting to invest in the market to try and chase a bit of a bigger return, can you imagine now we experience one of those events again, and when that ideal property comes onto the market and we want to put our deposit down, there's a good chance that if we've invested aggressively, markets have corrected and we have less than what we put in, which is why understanding that investment horizon is important and understanding how volatility works.
And just to add to Dev, the reason why, again, we go back to trying to look at the difference between a short-term time horizon and a long-term time horizon, typically talking to Dev's point about a deposit for a house, when the markets are down or have a downturn, you're wanting to access the full amount of capital. But if you're looking at a much longer time horizon, let's use retirement as an example, if in the year of retirement we have a year like COVID, you're not pulling all your funds out in that year. So you're able to, so to say, stomach the volatility to wait for the market to correct again.
Absolutely. So it's all about understanding what your goals are and then also coming to terms with the nature of investment markets.
And a big part of our job is helping clients understand what they can expect from their investments. And we have a lot of historical data to support this. So a big part of what we do is just educate our clients about the expectations they can have from their investments, knowing how long they're going to be invested and what they're invested in.